Have you ever wondered how exactly a credit score is determined? Just paying your bills on time and you're going to have a huge credit score, right? Well, not necessarily. There are actually 5 different components to your credit score, and today I'm going to break it all down for you. Why? Because the credit score is a major determining factor when it comes to home loans. Your credit score will determine your eligibility for a home loan as well as your interest rate, depending on the home loan that you're taking out. So let's get right into what you need to know. The 5 components that determine a credit score are payment history, amount owed, length of credit history, new credit, and types of credit. So let's tackle each one of these so you'll know exactly how to maximize your credit score. We'll start with new credit. New credit represents 10% of your score. This refers to the number of new credit inquiries you have in your credit report. In addition, it also refers to the number of new accounts that you have on your credit report versus what we call seasoned accounts, which are just accounts that you've had for longer. Credit scoring algorithms tend to favor more seasoned accounts. So if your score is mostly new credit, it may take some time to get the benefit of those accounts becoming seasoned. Remember, this section also takes into account new credit inquiries. New credit inquiries can affect your score by 1 to 3 points per inquiry. But keep in mind, if you are shopping for, let's say, a home loan, and you have multiple lenders pull your credit, as long as it's done within the same window of time, and generally the credit bureaus say 30 days, then that initial lender inquiry is only going to impact your credit score by that 1 to 3 points. So if you have 10 lenders pull your credit within the same, let's say 1 week time frame, and they're all home loan lenders, then in theory, that credit score is only being impacted by that 1 to 3 points. But good news, if you're checking your own score online, this does not count as a credit inquiry and won't affect your score. Next up, types of credit. This also represents 10% of your overall credit score. What this refers to is a mix of credit types, such as installment loans, revolving credit accounts, which are credit cards, and even home loans. Some examples of installment loans are student loans, auto loans, and mortgages because they are fixed for a period of time. Examples of revolving credit are mostly credit cards and many times home equity loans. The algorithm favors responsible use of a mix of credit, paying bills on time, and not exceeding 30% of your limit on your credit cards is a really big deal. In addition, the credit score algorithm favors credit usage. You may be surprised to learn that having revolving accounts and not using them could actually hurt your credit score, but again, it's all about responsible use. Now let's talk about length of credit history. This is 15% of your score and refers to the payment history as well as the length of time you've had the account. This section is one that grows over time. When you close an account, it can drastically affect your credit score, especially if you're closing out your oldest credit card. The next 2 I'm going to talk about are the most important and represent the largest percentage of your credit score. Amount owed represents 30% of your score. It's made up of credit usage and relates to your credit card usage. It's looking at your balance to limit ratio on your credit cards. The credit scoring algorithm wants to see that you're using your credit cards and that you're using them responsibly. Ideally, you want to keep these balances on your credit cards at 30% or lower. So if you have a limit of $1,000 on a credit card and your balance is $300 or less, awesome, that's gonna help maximize your credit score. But if you have a $1,000 limit on your credit card and you owe $800 or $900 or $1,000, now you don't have a lot of remaining available credit, and that's gonna actually drop your credit score. In a perfect world, to maximize the benefit and the component of a credit score, keep those balances on your credit cards at 5 to 10% of the limit. And now for the biggest impact to your score, drum roll please. 35% of your credit score is made up of payment history. This is huge. Paying your bills on time really does make a big difference. And what does that mean? What does on time mean? Well, when it comes to the credit scoring algorithms, if you're paying within a 30-day window of your due date, then it's not going to report late. But if you've paid 30 days or more outside of that 30 days, 31 days, it's going to show on your credit report through the credit bureaus that you've had a 30-day late payment. And the credit bureaus will track 30 days, 60-day late payments, 90-day late payments, up until charge-offs and collections. So The damage can be significant to a credit score with just even one 30-day late. The other component is how recent the late pay was. If it was a long time ago, like 2 years ago or longer, it may have a little impact on your credit score, but I've seen recent late payments drop credit scores by 100 points or more. I am not kidding. And not only do the late payments affect your credit score, but they could also affect your ability to qualify for a home loan as well. So if you remember nothing else from this video, it's to pay your bills on time, set up auto pay or whatever you need to do to ensure those bills get paid on time. Because when I talk to clients, honestly, it's because they went on vacation or something and got forwarded. It's not because they didn't have the money to pay it. And that one oversight, that one mistake can cost you greatly when it comes to that credit score. As a bonus tip, if you're somebody that pays off your credit card balances every month, just know that depending on when your credit report is pulled, that balance still may show the full amount that you had charged. This is a really big deal because we do talk with a lot of clients that do large payments on their credit cards, or in fact pay them off every month. But if we're pulling credit when the balance is not yet reflected, and let's say it's a $10,000 limit on the credit card and somebody just went on vacation and they owe $10,000, that scenario is going to drop your credit score. So the way around that is call your credit card company and ask them when they report to the credit bureaus, and then plan to pay your balance or pay it down or whatever you're doing. Pay that payment prior to that date that they're actually going to report to the credit bureaus. This will help you maximize your credit score, which is especially important if you're going through the home loan process. I have a true passion for home loan education, and I want to give you the information you need to make informed buying decisions. So be sure to subscribe and join our community. If you receive value out of today's video, please give it a like, and don't forget to share with someone who needs credit education. Until next time.